The bond market just crossed a line that it hasn't crossed in 18 months. On Thursday, the US 10-year Treasury yield touched 4.7%, which is its highest level since January 15, 2025. And that was days before Donald Trump's second term began. This is a confirmation that the higher for longer narrative markets tried to bury earlier this year is back, and this time it's driven by oil and not just the US Fed. The trigger is unmistakable. Brent crude has pushed past $100 a barrel, its steepest monthly surge in a decade. The surge is driven by Houthi attacks on tankers of Saudi Arabia's Red Sea coast and renewed US threats to escalate strikes on Iran spook energy markets. Just at the start of July, Brent had eased to pre-war levels of around $71 per barrel, after having surged to $120 at the peak of the Iran-US war. The tentative Iran-US ceasefire from earlier this year looks dead. War premiums are back in oil, and oil is back in bond yields. This move isn't confined to the 10-year. The 2-year yield rose above 4.3%, and the 30-year climbed to nearly 5.2%, marking a stretch above 5% not seen since before the 2008 financial crisis. Now, what makes this dangerous is the cross-current. Inflation data has actually been cooling, and weekly jobless claims just fell below 200,000, signaling a labor market still standing. Normally, that combination argues for rate cuts. Instead, oil-driven inflation fear is forcing markets to price the opposite. US Fed hike odds for July jumped to 26%. And polymarket traders now assign a 71% probability to a hike sometime in 2026. For borrowers, this means that mortgage and auto loan rates climb further. For Washington, it means that debt servicing costs on a swelling deficit get worse. The bond market isn't just flashing red, it's pricing in a geopolitical shock in US Fed can't fix.